Good afternoon, everybody. Welcome to the session. My name is Joe Fitzgerald with MoneyShow. We are very, very pleased and happy to have everybody here, including our panel. A couple of bits of housekeeping. I'll hand the ball right off to Eric. First and foremost, we want to thank everybody for joining us. These sessions are extremely popular. Thought leaders like the gentleman who are going to be speaking with us shortly, we appreciate their time and their insights. But folks, keep those comments and suggestions coming to us here at MoneyShow. It makes us better. Secondly, there will be a Q&A during this session. So there is a chat box that is on your desktop. Send those questions in, and we may be answering questions during the session, and then again at the end of the session, time permitting. But with that said, I would like to hand the floor over to Eric Balchunas for a phenomenal panel. Eric, the floor is yours, sir.
Thank you, and thank you, Money Show, for having all of us. I speak for all of us. This is a great, I love doing the Money Show. It's a way to connect with actual retail investors. I think I speak for all of us that a lot of the conferences and in what I call the circuit of ETF conferences are a lot of advisors and issuers talking to each other. So it's nice to talk and speak directly to retail investors. So if you have any questions, ask them. I've instructed the moderator to just break into the session if somebody has a question on the topic of hand, just as if we were doing this live. So for those of you who don't know, I'm senior ETF analyst at Bloomberg Intelligence. My job is to write about ETFs. There's 3 or 4 of us on the team, including a new hire in Asia and soon to be London. So we cover it across the globe. And I'm just a big fan of ETFs. I'm a nerd. And so we're going to talk about some of the trends up in Canada. I cover mostly US, but it's a lot of parallels. So, but everybody on the panel is going to be able to speak in Canadian ETF terms to you for sure. So let's go around the horn. Just, guys, give me a 20-second description of who you are and what you do in the ETF ecosystem. Start with Nassim.
Hi, good evening, everyone, and thanks for sticking with us to the last and quite possibly the best Money Show session of the event. I come from the trading side, so I spent 10 years at one of the large bank trading desks trading ETFs and other securities, an index analyst and an ETF fan. And then shortly after that, I moved over to the asset management side, working for firms that build and create ETF solutions for do-it-yourself investors like yourself, institutions, and advisors. So I currently work as an ETF strategist for Mackenzie Investments, the 6th largest ETF provider in Canada.
Trevor?
Good afternoon, everybody. It's always fun and interesting to play anchor to a conference. So hopefully we have a great session today. I've been in ETF since 2005. I've worked in some giant ETF shops. I've worked in some smaller ones. And for about 18 months now, I've been at TD Asset Management. We had ETFs. We went away for a little while. We've come back. And I think in the last 2-3 years, we've really come back with some vigor. So we're growing very quickly. We're happy to be here today.
Steve. You're muted. Steve, come on. Rookie mistake.
So much of a rookie mistake. I've only done 3 of these in the last 3 days. Nassim had it wrong right off the bat. Have to throw him under the bus. This is going to be the best panel of the Money Show, absolutely, other than my solo one that I did yesterday, which is pretty good. But that said, Steve Hawkins, CEO of Horizons ETFs, been in the ETF industry now for since 2007. We're the 2nd oldest ETF provider because I don't count TD's first shot because they closed that down. And we are the 4th largest ETF provider in Canada and the oldest ETF sponsor of the Money Show here in Canada, I have to say.
Thank you. And Dwayne.
Well, thanks, Eric. And it's great to be here, and I welcome everyone and welcome to my colleagues. I was quite pleased to see Steve on mute there. You don't often get to see that experience. So I'm glad maybe this is even taped or something like that. But no, and all things being equal, usually being the last session at a conference means you're usually that session just before the cocktails. And so people want to roll through you, but in a virtual environment, who knows, maybe you've been cocktailing all day for all we know, but no, really looking forward to the chance to chat with you. I'm president and CEO of Franklin Templeton Canada. And so as an asset manager, I'm coming at today's panel more from our business standpoint. I'm certainly going to defer to my colleagues here on the technical stuff because they live and breathe this. They've got big brains around ETFs. So I'm not going to even try and run parallel with them on that. But we got into the ETF business in 2017 as another way to deliver our investment capabilities to investors. So really looking forward to the chat today.
Thank you, Dwayne. You win best background, by the way. That is a cool looking painting behind you. I always love I go to the Museum of Modern Art in New York about once a year. But anyway, to Dwayne's point though, by the way, I actually organize conferences at Bloomberg all the time. And I always say the same thing. We're between you and drinks. And so one time we had a smaller conference and I said, let's do the drinks before the last panel. Don't ever do that. Basically a crowd starts to form in the back and it's so noisy, nobody can hear anybody. Like you just can't do it. I've tried it, but at home, I guess you could, break out whatever and, enjoy yourself while we go through this, but we'll try to make it as exciting and lively as possible. So the name of this panel is Innovation Unchained, how to capture long-term growth with ETFs. So I have a couple prepared questions. I just want to start with that concept, which is Unchained, because there's an explosion of products in the ETF world. I think if you if you're retail investors and you're looking at all the products, it's probably a little overwhelming. You have so many options. I mean, I frequently call the ETF industry the Silicon Valley of the financial world, and there's all kinds of gadgets coming out. So I guess I want to just get your flavor on when somebody's approaching the ETF industry, what advice would you give them in terms of trying to narrow down what to invest in and then what ETF to pick? So let's start with TD, Trevor.
Yes, thanks. So, as I mentioned a moment ago, we've been pushing really hard for the last 2.5, 3 years now. And we know we're late to the game. So I think one of our strategies here has been kind of the Avis, we try harder kind of thing to innovation in the ETF space. And I think to us, that means taking a look at some of the legacy product that's out there, whether it's covered call ETFs for income, whether it's the NASDAQ index ETF, and trying to build better mousetraps. We knew going into this, if we were just going to have, a Me Too product or an also ran, whether we were a basis point or two cheaper, no one was interested in that. So we've tried to innovate and look at the category by adding in, our own IP with regards to the indexes we follow. We create some indexes of our own, or full-fledged, fundamental active management wrapped in an ETF.
Steve, why don't you jump in here? I mean, you guys launch a lot of products. You've got a lot of thematic ETFs. And this is a good question, which is sometimes ETFs are filed, and I look at the filing, and I have to go Google what in the heck it even is. And I'd had to do it with your psychedelics ETF. I'm like, what does that even mean? And now I realize it's a kind of legitimate theme. And I guess, can you talk about how you are out there looking for new ideas for ETFs to serve up?
Well, I mean, we really embody innovation in everything that we try and bring to market here in Canada. We, as Trevor said, I mean, we are definitely not a Me Too company. We like to bring all of the firsts of their kinds to Canada. We're the only unleveraged player for the self-directed marketplace. Here in Canada, we, for the first marijuana ETF, and people didn't know what marijuana was really, when we were launching our first ETF, HMMJ, and then psychedelics this year. And, we're looking at some very new concepts again, which the key words are going to be, what is that? And we love it when people are asking that question, what is that? And should I be investing in that? And for us, it's really trying to break the mold. Canada, we have the benefit of having regulators that work with us. We're allowed to bring new and innovative different ideas to the marketplace in many different types of structures. And it's just fun and exciting. I mean, innovation is our capital, is our, backwards slogan. And, psychedelics as an example this year is something new and exciting, which, there's a lot of talk and hype about this subsector and it's a new theme. This is not your traditional energy or bank stock, which is all you really see in Canada from a broad-based index perspective when you're dealing with Canada. So you gotta push the limits, and what we really try and do here at Horizons is do something different in that regard.
So Dwayne, let me hear from you here. You're Franklin. A lot of people know Franklin from the mutual fund world, active mutual funds. You've come over, Franklin's come over. What has been your strategy? What are you speaking to investors about with your products?
Yeah, so I'd say broadly our platform in Canada consists of, we've got passive country ETFs, we've got strategic beta options, and then we've got our active. And really, our forte is really in the active space. Well, I guess I shouldn't diminish any of those. Where our forte is in all three of those areas, but really on the active side. And to me, it was it was really in my introduction, whereby, the ETF market in Canada in the space is really dynamic. As Steve said, it's a lot of innovation going on. There's a lot of great manufacturers of ETFs, but I think there's a lot of room for a lot of manufacturers of ETFs because it's not a one size fits all, out there. And so for us, it's really our strategy has been, how do we give Canadian investors access to more of our capabilities, but not necessarily in a mutual fund form? So how do they, we all know the benefits of ETFs, the tradability, the ease of use and building blocks and portfolios. So I really just look at our strategy as, how do we just make our capabilities available in vehicles that really, if a Canadian wants an ETF, if a Canadian wants a mutual fund, we've got that capability available for them.
I'm going to assume Eric is saying, hey, Nassim, why don't you chime in with your thoughts on that one? Because he made the Steve Hawkins mistake of being on mute there.
What comes around goes around.
Oh, you earned that one. But when I think of Mackenzie Investments as an active manager, we're well known for 53 years of serving Canadians in that space. And when Michael Cook launched the ETF business here a little over 5 years ago, it was using that active strength in the first series of products, and then recognizing, as we talked to our advisors and worked with the public, they needed more, and they wanted someone to be able to say, hey, I can choose from mutual funds, I can choose from active ETFs, I can choose from strategic beta ETFs, and now index ETFs. It's the whole menu, and how do we innovate how we communicate that message? And that's how we were able to grow our assets so large, is being able to talk to the advisor, help them solve problems with the various solutions as they continue down their journey, like the innovations in the space for having mutual fund or ETF portfolios that buy ETFs to help people kind of take that step from mutual funds to ETFs. And now, of course, asset allocation ETFs. Like, there's so many different steps that you've been able to go, and being able to present that picture as a fulsome story, not just it's not mutual funds or ETFs, it's they can work together, they can be better together.
Yeah, and I guess let me go to Trevor here on this one, and just this idea of active and ETFs, and anybody can weigh in here. Obviously, passive generally means like market cap weighting the whole index. Typically, those are cheap. They go in your core. And then there's active, and there's all variations of active. Can you talk about that in the ETF world? Like, should we consider like an ETF that tracks electric vehicles active? I mean, we do. So can you talk a little bit about how the portfolio looks these days, and how ETFs that are active are playing a role in those portfolios?
Sure. And I mean, I think there's a couple ways to answer that, right? Nick Murray, a legendary coach to investment advisors for many decades, in one of his very first books, has this great passage where he says, think of the single best gift you ever got in your life. Was it a sweet 16, a graduation, first car, first gift your son or daughter gave you, and as Nick Murray writes, he says, now tell me how it was wrapped. And nobody has any clue. You can kind of think, oh, my first bicycle, or, whatever it was, my engagement ring, whatever, but you don't know really what the packaging was. And I think that's kind of the world we're rapidly getting to, where, you can have index mutual funds. Those have been around forever. You can also have active ETFs. The packaging itself is going to matter less and less. And I think this is why you see more and more mutual fund companies entering the ETF game, not just being a fund company, but being an asset manager. So, to me, if I think of, say, electric cars as a theme, if that follows an index that someone has a rule set for, that's narrow beta to me, and you have to be careful, because if you don't buy all financials, but you buy broker dealers or insurance or banks, you're starting to really, really narrow down the focus. But that's your option. And that's the beauty, I think, of where this ETF is going. Choice is good. We have fundamental active. And again, we have index ETFs where we made the index. So it's actually TD's IP that is going into the creation of, say, our healthcare ETF or our technology ETF. And again, what we're trying to do here is improve upon the legacy products that have been around for 10, 15 years or longer.
If I could jump in, Eric, like, I mean, the one thing that I would say is the one great thing about something like electric vehicles or cybersecurity, like these are sort of high conviction individual themes, and I'm going to call them, not from an active managed perspective, whether they're passively managed or actively managed is not really something I care about. I care about the ETF wrapper itself. But the fact that like Canadian investors have been such home-centric investors for like the most home-centric investors in the world, the largest fixed income investors on a proportionate basis in the world, and bringing new themes and types of ETFs to this marketplace here is really allowing Canadians to, access growth that they haven't before, expand beyond the Canadian borders, really, make an elective investment into a disruptive technology without having to, take on the individual security risk per se that they would have to be doing by buying one specific like Hive blockchain or versus Riot technologies or crypto or Galaxy, you know what I mean, when it comes to blockchain and cryptocurrency mining. When you're dealing with an ETF and you can provide the diversity and the less risk intense of a new sector that's evolving, that could be changing the marketplace, that can be bringing new technology. I mean, I think these are exciting times. This is why ETFs were built, was to provide these really simple and easy ways that what end clients can access these new technologies or even just simple broad-based equity in a very cheap and reasonable format and easily tradable on the exchange.
Let's go to Dwayne real quick on this question, which is, generally when we're talking about active, there's, as somebody said, narrow earlier, there's narrow high octane active where it holds maybe 30 stocks. It's a thematic ETF or something like the Cathie Wood funds. Those become pretty popular. We refer to those as hot sauce. And they generally are put on top of an otherwise really boring portfolio. How do you position Franklin and that active versus that and versus say cheap beta?
I think it goes to even what Steve was just saying. I think, it's the benefit of the ETF and, it takes away that single stock exposure risk that you might have. It allows you to get into that basket, even if it's a concentrated basket or a broad-based basket. And I think, the term that, I use often is that it's kind of that core satellite. It's another building block. If you want to get a little bit more, if you want to ramp up the octane on that portfolio, you can get into some of these other ETFs, even if they're actively managed or not actively managed, you can ramp up the octane in those while still, using it as the building block for the overall portfolio. So I think that's what really speaks to the innovation in ETFs. And what's really exciting is there are so many of these slices that you can now use to build. And I think that's the one that I guess I would not say as a cautionary tale, but say as it's great to have them, but it's like any stock. Would you put everything in one of those? And it's about building that balanced portfolio, using all of the tools that you've got. And
I guess, Nassim, I would also ask you that, I look at McKinsey, you've got a pretty wide range of products there. And I guess, how do you see that question, which is, okay, maybe I have a pretty vanilla base or my 401k and I'm going to the ETF market. Should I be looking for something that's really different than my current portfolio or something that has some of the same stocks, but does maybe some tilting?
For sure. And it always comes back to we're still talking to the camera. I don't know who's on the other side of the screen, so I can't give you, the key investment advice. But I'm about to tell you the 5 tickers that you buy right now and you will be completely successful. Ready? No, it's really understanding what you can do and where you can go with your portfolio. If you're just starting out, if you're a beginner investor, you're going to want to just get your first dollars to work. And, are you going to use a high octane ETF and be able to brag to your buddies, hey, it doubled or it did this great number? or learn very quickly what these ugly negative red percentages are in your account. Like these first trading experiences are going to define you as an investor. And can you start out with, a large cap Canadian index? Can you start out with, an asset allocation ETF that buys a little bit of everything and be happy with, 1, 2, 3% growth every quarter? Like that's actually pretty good. As you get older, you'd be delighted to have those kind of returns. But if you really are looking for that excitement, you have to decide how much of your portfolio can you allocate to that excitement, and is it 5%, is it 10%? Like, where are you on that spectrum? And where you don't have any alpha, when you don't want to do that research, if you don't want to be, coming on to conferences like this and learning about interesting ideas and hearing from intellectual people, the interesting thing is we're all going to be on here and tell you about our great products, and we're not going to tell you when to get out. Right, we're not going to tell you when to rebalance. So these are the strategies that you got to keep in mind. Take a cheat, look at our asset allocation ETFs. You can see the holdings. Here's a percentage growth to or allocation to the US. Here's a percentage allocation to Canada. Where are you in your portfolio? Are you 90% US because I heard these great ideas on Eric's podcast Trillions and I just dialed into them, or do I have that nice portfolio that I can just watch it grow over time? That's where you really got to start.
Can I jump in with a quick question, dovetailing Nassim? Someone's asking, for investors in your ETF products, do you guys provide tools that allow a risk rating for the portfolio of ETFs when you start ramping up to make sure you are maintaining a handle on that risk?
Well, we endeavor to keep the risk rating that'll be posted up on that website. For the different types of products, we simply can't deviate, because for an index product, we have to replicate the index. That's our goal. We get the index files every day, and the technical details to do that. We're measured on something called tracking error, and we want to get that as close to zero as possible to give you that index exposure, whether it's a narrow index or a broad index. On the active side, if the products start doing more exotic things, we have some active fixed income products that will use puts. When the market is down, if they take more exotic ways of protecting the portfolio, that can change the risk rating. So you really do have to keep an eye, maybe quarterly, on the products that you invest, or subscribe where you can to get updates.
And you said something about the 5 ETFs. I will say, at the Money Show, I think a lot of people come here looking for specific products. So this is one of the cases where I would bring up specific products, especially ones that you are proud of. I think this is one of those cases where you would do it. I think sometimes at an ETF conference, that's when you talk a little more big picture, but feel free. And with that said, let's turn to something that's pretty exciting, which is a little break from ETF and application, which is the crypto world. I think it's probably only going to pertain Steve, but let's just take a quick side road off of here. There's now, in the US, we still don't have a Bitcoin ETF. Steve, you've got, I think you have a futures one and a regular one, right? A physically backed one. Is that right?
Three physically backed ones and 2.
Yeah. So could you explain to investors, I guess, how that works? Do you go into the underlying Bitcoin market and buy it when you get flows? And just explain why an ETF is so sought after to do Bitcoin with. Where you can, because you can get Bitcoin pretty easily now direct, and B, there's trusts out there that don't actually track very well. What is it about the ETF and that is so sought after for this? And clearly there's interest. There's billions in it at this point, which in US
over 4 billion, over 4 billion now.
Right, and in US terms, that's about 70. Because your market is 27.
It's more like 100 million US.
It's like $1 trillion in the US. That's how small Canada is. Just kidding. I'm not that US, egotistic, but it is 27 times smaller.
I mean, I think there's 2 really big factors of why sort of cryptocurrency ETFs between the Bitcoin and Ethereum products in Canada that have done well. And it's really about ease of execution, and it's about transparency. When you're looking at the stock exchange and you're looking at an ETF, which is listed there, you see a bid ask quote, you know exactly what it is you're paying for every single time. You can buy on the offer, sell on the bid, and you always know what it is. When you're talking to a cryptocurrency exchange, it's done differently. You don't have the transparency of a public, liquid, regulated marketplace, as well as you don't always know what exchange that you could be working with. I mean, I loved it when there was a Bitcoin commercial that was playing here in Canada, and it showed it showed somebody buying on a Bitcoin exchange, and it went all the way down a chain, all the way to a guy that looked like 12 years old with some stubble on his hair and a hoodie in his mother's basement, and his mother's yelling that it was dinner kind of thing, right? And that was where you were buying your Bitcoin. Like, that is not what the world is today. It is significantly more transparent, but the ease of execution through a stock exchange just, I think, is a very different animal as to going to a crypto wallet, owning your own crypto wallet, owning a crypto bank or a trading account with a crypto exchange, which, still are unregulated for the most part in North America, and, not allowed in most countries, or not most, but in many countries around the world. So it's just a very, very different animal. Again, back to Dwayne's point, the ETF is really becoming a vehicle of choice when it comes to investing in all asset classes. And then the sooner that we can get an ETF launched on a brand new asset class like a cryptocurrency, the better off that ETF producer is going to do. I mean, you saw it, when we had one Bitcoin ETF launch the first day, the very first one raised $1 billion, and the next one launched the next day and it only raised $50 million. I mean, there's a huge difference in Canada when you're dealing with $1 billion versus $50 million. And all it took was 1 day difference, right? So, but it's all about the vehicle of choice, and ETFs are really becoming the vehicle of choice for all asset classes.
That said, it seems like there's 4 of them now that have pretty decent asset sizes. Like, the love got spread around ultimately, but you're right. Early on, it looked like that 1 day lead was just enough to really completely change the market share. But it's evened out a little. 3iQ has some decent assets, and a couple of as well.
A lot of investors come in. CI's done very well on Ethereum, selling it with zero management fee. And again, and there's 4 Ethereum ETFs out there, right? But there's only one that's been really doing well, and they cut their fees to 0 for the first 6 months. So, but it's the vehicle of choice for the asset class. And again, like, I still don't have a cryptocurrency trading account. I still don't have a cryptocurrency wallet, but I love trading Bitcoin, be either long or short. And again, we're the only ones who have an inverse Bitcoin ETF in the world. But again, it's all about the efficiency of trading a vehicle and the underlying marketplace, and whether or not you have a strong conviction one way or another way. And ETF is just the easy way to get in and get out of these marketplace with significantly less risk, things that you have to think about in the back of your head.
Yeah, and I would just reiterate that ETFs are, regulated, and they just have a lot going for them. I wrote a book on ETFs, and I was amazed at just how many advantages they offered. It reminded me of like the MP3 or Uber, where it's just really hard to not use it. But anyway, let's talk a little bit about another popular trend, not Bitcoin, but ESG. I searched all 3 of your issuers' products for ESG. Sorry, all 4 of you guys. It looks like only TD has them. Now, am I wrong? You have them too, Steve. Sorry.
Got to get the research team on this one.
Yeah, hold on.
No more researching from the airport.
Listen, Steve just talked a lot. Let's just go to Trevor. I know you have 3 of them. Look.
Yeah. So
look, Trevor, let me set this up a little bit.
Yeah.
I'm going to be negative Nelly here.
Yeah.
What's the point? I mean, you guys in Canada, you make so much money in the oil industry. It's legal. I drive a car. Why do I not want to invest in stuff that I'm a customer of? Like, what's really going on here? Is it just a lot of like, oh, we just want to make you feel like you're doing something, even though you're not doing anything?
Right. Well, the first thing about ESG, I guess, to start with, is that there's a spectrum, right? You can go back to the beginning, go back 30 years ago. We had ethical funds in the 90s, and all they really did was buy tech stocks and banks. And that worked until, 99, 2000. That was a great little racket there for a while. I think responsible social investing, environmental social governance investing, it's really caught on more institutionally, I think, than retail at this point. But I think we feel that the market has passed this inflection point. We've gone from why would I do this to kind of why would I not do this? And I think the analogy I use with self-directed investors who are maybe on the viewership today is going to the grocery store. When I go to my grocery store, I see sort of domestic, local grown apples. I see apples that somehow are flown in from overseas and they're cheaper. but they don't really have the sort of pesticide, fungicide regulations that we would have here in North America. So it's a little less expensive, but I'll probably buy the domestic stuff. And then, 5 years ago, the organic stuff was like twice the cost. So, I'm good with those Ontario grown apples for the most part. Today, though, organic is barely any more expensive than regular sort of non-organic produce or meats. I know it doesn't taste any better. That's all in my head. I know scientifically it's not more nutritious, but really the perspective is like, why wouldn't I buy organic? Why would I take the chance that there's some allergic or adverse reaction to something that's new or unregulated as far as pesticides and things go? And that's kind of ESG. Some investors view ESG as a way to get dramatically better returns. And you kind of have to move the goalposts to just pick a period when energy is weak to really sort of come to that conclusion. I think personally, ESG is more of a risk metric. So take two giant Bay Area tech stocks. One has a diversity and inclusiveness policy and one doesn't. And let's just say for the sake of it that they're the same size, same profitability, et cetera, same industry. Well, which of those companies is more at risk of a discrimination lawsuit? And would that be material to the share price, that controversy? Two pipeline stocks, out west here in Canada, right? Shipping oil and gas, sometimes into the US and sometimes not lately. If one of them has a spill response team and one of them doesn't or used to but cut back, when that spill happens, will that become a material risk, penalties, fines, bad press, etc.? So ESG to us is really a way of, investing with a sense of conscience, but also trying to limit some of the risks that exist. We do have energy in our ESG ETFs. They're the lowest cost in Canada, so they're barely more expensive than buying, plain vanilla beta. But we want to take it from that sort of risk perspective as opposed to trying to shoot the lights out or greenwashing or something like that.
And maybe I'll just jump in then, Eric. And I think, Trevor, you just did a great job. And I think that's the most important thing for me when we bring up this topic of ESG is that there is that education of what it is. And it's not a product to me. It's an investment process and philosophy that is used to build to select stocks. So, Trevor, you did a great job talking about, exclusionary stocks and responsible investing. Those are products, and it's easy to build an exclusionary portfolio. But to factor in the E, the S, and the G, it's leading institutionally. We're the sixth largest asset manager in the world, huge presence in Europe, and we're seeing this on our institutional side in the European market where there is a big onus on, are you Article 8, are you Article 9? Where are you within the ESG? How have you incorporated that into your investment management process? And I think for Canadians, and I'm welcoming, this might be an odd thing to say publicly, but I welcome the regulators getting more involved in this because it's becoming to me more smoke and mirrors from a marketing standpoint. And, and I can say that with the confidence that, we have ESG, or we're calling it sustainable ETFs. But we've been doing these strategies in an active mutual fund form for 30 and 40 years and have been doing that. We have the track record. We can back it up. We didn't just go and say, we see the trend in Canada towards ESG. We think there may be an opportunity to gather assets. So we're going to hire a head of sustainable investing and bring them from whatever industry. You got to be able to walk the walk and talk the talk. And so, I think there's going to be more governance on this issue going forward. But I think people need to understand that you're not necessarily sacrificing performance to have investments in an ESG or sustainable type portfolio.
I will say it's a little subjective and confusing sometimes, though. Like we had a webinar the other day with our ESG analysts, and like a question like, is Tesla ESG? Should it be in an ESG fund? It's a very controversial question. Some people are like, well, their G is awful, the S is so-so, and the E is really good. Although the amount of carbon you need to make that E, like electric vehicles, you have to use fossil fuels to make the whole network. You could argue there's embedded carbon in that E. And so hardcore analysts are like, no, Tesla's not ESG. Some of the other ones would be like, well, given what they're going to do, I'm going to look the other way on those other two. Anybody want to weigh in on that subjectivity of like, because if you do buy an ESG ETF, would you be surprised if Tesla isn't in there or is in there? Anyone?
I'll start
ahead.
out, and coming from two different large asset managers, it was the same. Every time you have a head of social responsible investing inside the shop that's going to every investment team and asking, how are you incorporating ESG in your investment process? What are you doing to take into account some of these principles? How does it work for your particular fund or strategy? So you are going to get some differences. And some of the talking head conversations that go out there that do talk about regulations, it can actually scare investors away from this because they're worried that they're not being protected, when we're all actually starting to think about the right things about investing. Dwayne talked a little bit about Europe, and if you compare that to America, Europe is way ahead of us on adopting environmental and caring about society and all those governance elements that are so wonderful. We're UNPRI signatories, and IGM is well ranked in the global scale. And even tomorrow we're launching MGSB, a global sustainable bond. And one of the leaders on this fund comes from Germany. He's been passionate about these sustainable bonds, the green bond kind of initiatives, and it becomes pervasive through the organization when you're thinking about that from your style. So we could see this ESG as that thematic ETF over the next couple of decades, until all of our funds and all of our investments they just do that by normal. And then we'll have to be launching ETFs that are anti-ESG. Right, we'll have to go the other way because we've gone full circle,
Right.
and we've gotten better.
I still
with
think someone should
investments.
launch that. It's not anti-ESG, it's just ESG rejects. Because if all the money goes to the high ESG, it's almost like a factor premium for buying the rejects. But anyway, look, I think this is a great debate. Now, there's ESG, which is exclusion, you put it in, and then there's clean energy ETFs. And Steve, I'll turn to you. One of the ones you have that was in my top 10 ETFs to watch for next year wasn't your ticker, but one in the US, URNM. It's Uranium Miners. That has been on fire. Can you talk a little bit through, looks like yours is doubled this year in size.
Yeah.
Still not that huge at the 40 million, but it's doubled. Talk about that theme a little bit and how that might fit into a portfolio.
Yeah, so I mean, alternative energies are something that we believe is part of the whole ESG ecosystem on a going forward basis. We're not putting these funds out there as ESG, but they are alternative energies to the typical oil and nat gas when you're dealing with our uranium product, HURA, along with our lithium product, HLIT. These are two very important energy sources or stores of energy on a going forward basis for our society. Technology itself and how it's using energy. And, we're going to run out of oil. We're going to run out of nat gas. We're going to run out of coal. We will not run out of uranium. And, from how it builds or is used in nuclear energy, from how we build batteries with lithium. We also launched a hydro ETF, so hydrogen. We're very, very bullish on, the uses of hydrogen. We think there's going to be a lot of changes in technology, and it's going to be continue to be more efficient on a going forward basis to create as an alternative energy out there to the typical fossil fuels, which has really been one of the backbones of the Canadian ecosystem as it is right now. But like I said, uranium, lithium, hydrogen, these are all very important, we call them sustainable energies on a going forward basis. And I would say you're going to look for more to come. Our sister company in the US has launched solar. They've launched another water ETF. These are all very, very important things to think about when it comes to our society and going forward. And it's really just a sort of a continuation of the whole ESG framework that's out there.
And speaking of just things to watch in the future, again, a lot of people here are looking for ideas. Let's go down the line here. And, one thing to just get your brain going is tech trends over the next 5 to 10 years and some ETF products that may be able to capture those. If you don't have a product like that, just give me something in your lineup that you think has real future potential. So let's go down the line because we're sort of coming into the closing part of this panel. And I really want to highlight some products here. So let's start with Nassim on that one.
Sure. The greatest technology and innovation that we've had is really the asset allocation ETFs, and bringing something that puts a bunch of different ETFs inside one ETF and charges you a low low cost, like our MGRW at 17 basis points. This is one of those ones where you can just buy it and enjoy it. It rebalances for you every quarter. You get the asset allocation team deciding what the strategic allocations are going to be every year, and you can buy that and enjoy it. And it's going to catch the tech trends inside it. You're going to have access to the large cap ETFs. You're going to have access to the country ETFs that we have.
What's the ticker on that one?
MGRW. These asset
So
allocation
you're basically
ETFs.
saying that you're saying that basically you buy this thing and then you can just go like do hobbies and stuff. You don't have to even worry about any of this.
Yeah, and my fellow speakers are going to come up with some really great ideas and at this call, but I challenge them all to call you after you've bought that ETF and say, this is the time to roll into the next one. That's what I want to hear, because
Listen,
this is the best innovation we've done with ETFs, is bringing that price down. And
it's a
giving you
novel
great
answer.
asset
I
allocation.
will say that. I do think advisors are leery of using those because it's sort of like, well, that's my job. But for direct retail, I get, these asset allocation ETFs do make a lot of sense. And
There's
we
so many
sometimes
other
refer to
things
them
for
as
advisors to do. Like there's so
FOMO
many
proof.
things they can help advisors. They can see what their other solutions are, their needs for their accounts, their needs for retirement. There's other things beyond investing, and if they're okay at investing, well, maybe it's really hard to outperform this product. Like, this is a great benchmark for them to put into small accounts and watch.
Yeah.
Not to throw Nassim under the bus there, but like the one big thing when it comes to these products, when you're dealing with ETFs, there's over 900 in Canada now. Like we're getting close to 1,000. There's well over 3,000 mutual funds. But of those 3,000 mutual funds, there's almost like 500 balanced mutual funds, right? Here in Canada, we're growing on these one ticket solutions, these asset allocation ETFs, but they're all done a very little bit differently. And you just need to understand what it is you're buying with all of them. And I think it's very important what Nassim said with respect to fees. But knowing what is underneath the hood of these ETFs is extremely important, because they're all being constructed a little bit differently. And there is a lot of money going into the space, as you said, Eric, but it's really all coming from the self-directed retail clients themselves.
No, I just looked at it on the terminal from Eric's own shop, $1.1 billion into just 18 asset allocation ETFs in Canada. Like it's incredible just how many dollars are going in here, because it's an easy solution. It's an innovative solution, even though it's extremely boring. And Canadians love balanced product. Like, it's one of our largest asset classes here. So we don't always have to sell with the fringe or shoot for the fences.
Yeah, it's interesting. I'm doing research for a new book, and I was talking to international head of a big asset manager, and they're like, when you go out of the US, because their 401k plan forced everyone in America to become like interested in the market, because you had to like pick your plan. A lot of people did anyway. Elsewhere in the world, some people just don't want to deal with it that much. Like, so I totally understand that sort of like, easy button kind of solution. And we also talk about how some of these we want to see one come out, the name of the FOMO proof ETF. Because if you own everything, then you never have to worry, do I own Tesla? Do I own GameStop? Do I own AMC? I own it. I don't ever have to worry about it. Whereas some other products, like even the S&P was late adding Tesla, didn't add it until December, but the total market had it and a lot of the balance funds did. Okay, Trevor, you're up.
Yeah, so I mean, I'll take technology literally, and I'll talk to ticker symbol TEC, which is our largest ETF. It's actually the largest technology ETF in Canada at this point, at about $2 billion. We looked at technology products as they existed, whether that's sector spiders or NASDAQ 100 ETFs. And the trouble to us was really dilution or contamination. The NASDAQ is a great index, but it's got, Doritos and Oreos and pumpkin spice lattes in there. It's not technology. It's also going to miss out on tech that might be NYSE listed, Visa, MasterCard, Salesforce, things like this. So we made our own technology index. We brought back in names like Amazon, which is a consumer stock, or names like Alphabet, which is a communication stock. And then we also added elements to that disruptive technology. So we have cloud, we have crypto, we have robotics and e-commerce and blockchain, but we're just not putting all of our eggs into a single basket as far as the thematics go. So you have exposure to all those really new disruptive technologies, but the product is anchored in very, very profitable mega cap tech. And those are the companies that are really stalwarts when we've had some volatility like this week. And those are the ones that are really benefiting from the reopening trade as well. So that's probably our tech flagship that we'd want everybody to know about.
Okay. Steve, I know you just got a whole thing on uranium,
Sure.
but I'll give you another shot. You can't pick uranium, cannabis, or psychedelics. None of the fun stuff, okay?
Okay.
What else you
So
got?
I've always been a long time investor in SMH semiconductors, love semiconductors for a very, very long time, but we did not have a Canadian property semiconductor ETF here in Canada. We launched one earlier this year, CHPS chips. We know the semiconductor trade is here. We know that there's continued to be a global shortage in semiconductor. We know that all new technologies are going to need semiconductors on a going forward basis. This is a trade that exists now. We're going to see huge growth in the semiconductor marketplace. And that's why I like investing in a Canadian ETF, and CHPS is now my investment over SMH. So that's where I'm putting it, is semiconductors. When you want to invest in technology, invest in the infrastructure of that technology. What is driving that technology? It's going to be a semiconductor chip.
Yeah, I guess I call semiconductors the oil of tech. How's that? What do you think? It's on the house. You can steal it for your next tagline.
I don't like it, Eric. If it came from you, I don't like it. So, but
I think up here we call it
it.
picks and shovels, right? Given our mining background, so the suppliers to the industries.
Well, look, labeling is huge in this industry. Let's be honest. Sometimes just the right phrasing, can make or break it. But anyway, all right, Dwayne, you're up.
Okay, I guess I would certainly stick with that innovation technology theme, and it would be the Franklin Innovation Active ETF, and its ticker is FINO. And that really leverages the decades-long Dynatech fund we've had in the U.S. that we've now brought to Canada this year, and have this active ETF based on that. And being based in Silicon Valley, it really is investing and getting that insight into those key tech names, Amazon, Alphabet, Microsoft, Facebook, Shopify. So really on that innovation technology, looking for those up and comers in that space. So if we're talking about tech, this would be my recommendation.
You're on mute,
You guys
Eric.
also have it. I know, Steve. I just need to pay attention.
I had to say it once.
Keep you on your toes, Eric.
Okay. Look, I know we're at the official time. Since we're last, we can bleed over, but let me ask the moderator if there's been any questions.
There's been a bunch. You guys have really nailed a lot of the questions or the themes. A couple of quick ones if you want. In investing in ETFs for the long term, how important is AUM for a fund and the track record of a company that closes funds because of insufficient AUM? And what has the experience been with each of the panelists and their companies in this regard? Any thoughts?
I mean, I like to hear myself talk, but I like well-established ETFs and ETF companies. The AUM is not too much of a factor per se when you're dealing with an established company, because they have this economies of scale, so that it really doesn't matter if a fund is sitting at $10 million. It's still, they're not losing money out of it. They're not going to necessarily be promoting it actively from a marketing perspective, but young funds take time to grow. Eric said our uranium fund, it's over 55 million now, but it's taken 2 years to get there. And it's only because uranium has taken off so substantially in the past year. But knowing who the provider is and what the provider does, and knowing that there's substance behind the provider, I think is very important. And with all of the groups that are on here today, you're dealing with well-established asset management companies that have a long track record of being here in Canada with respect to either mutual funds or ETFs. And don't be weary of any of Mackenzie, Horizons, TD, or Franklin Templeton ETFs. You're good to go.
Well, and also, can someone just explain, let's just say you buy an ETF with $10 million, which is on the small side, and it decides to liquidate. Explain what happens, Trevor.
I can do it from a theoretical.
In the event that an ETF liquidates, you get your NAV back, right? So it isn't like it goes to zero. You get whatever the net asset value is of the product. So if that was stocks or bonds or REITs, what have you, you would get the liquidation value of that. That said, it is a taxable event, so you've got to bake that into your own taxes that year if you're filing income taxes on that investment. You've got to now reassess the landscape. You've got to, rejig your portfolio. And so I think all the ETF providers recognize that there's some reputational risk to closing an ETF. It hopefully means, knock on wood, it hopefully means we don't throw noodles at the wall and just sort of see what sticks. We want to launch products that have sort of fundamental or academic value to them. But at the same time, you know, if there is a $4 or $5 million ETF that's shooting the lights out, well, larger ETFs within under the umbrella of a company can sort of subsidize or help spread those costs over until it finally does gain traction. And that's, I think, for all of us, really, we've all got some smaller ETFs that are really great ideas. They just haven't caught that traction yet.
And if I can build on you, Trevor, there, if we have an ETF that's one of our largest on the shelf that's doing Treasury inflation protected securities, like inflation has been a thing over the last 2 years, but when we first launched it, no one believed it, right? No one thought inflation was a thing. So it did sit at smaller size, slowly gaining assets. And then all of a sudden, when that theme took form, the assets come in. So it's not really something that us issuers really want to do because we don't know when that cycle is going to come for that ETF. So we got to keep it on that shelf, and that economy of scale is critical.
We all got to have 30 boats in the water because we just don't know which way the wind is going to blow. So you're always going to see that.
That's true. However, on the reverse, there's been a couple cases where an ETF closes just before that moment happens. The short squeeze ETF in the US is a great example. Right before the meme where it would have held AMC and GameStop before all that. Yeah, and also there's 3 airline ETFs until finally Jets was the one that won. That moment came, but that was a 15-year waiting period and 3 different. So it's fascinating. We really track this a lot. Any other? I guess I'll turn it back to the moderator for another question.
Sure. There's been some little talk just recently in the last 10 minutes or so. Can any of the panelists talk about inverse ETFs, such as the very profitable Beta Pro Inverse Bitcoin, the BITI.TO, and any other thoughts on inverse ETFs or even leveraged ETFs? Any thoughts there?
Yes,
I don't know if there's anybody on the panel that knows anything
I'm just going to
about
mute
that.
my mic. I'm going to mute my mic and let Steve take this because I shouldn't answer this.
Well, we're the only leveraged ETF provider and only inverse ETF provider in Canada. I love BITI as a trading vehicle. I love all of the leveraged products as trading vehicles from a short-term perspective. When I feel I have I can make money in the short term by going against or going for one underlying sector. I mean, HX or HQU, which was our NASDAQ leveraged up 2 times product, had a fantastic 2020 from March 31 to December 31. I think it was the best performing ETF in Canada. Guess why? The NASDAQ was up so much and tech was up so much. And when you go 2 times that, you're going to do very well. Our inverse ETFs are very highly correlated to our long beta ETFs as well. So like if you want to hedge something, if you got money sitting on the shelf and you're just not sure, you don't want to sell your S&P 500 because you don't want to realize the gain on it and pay taxes on it, you can buy inverse S&P 500, just like you can buy inverse Bitcoin. These we use as hedging vehicles primarily in the portfolio. When you're dealing with minus 1x, when you're dealing with minus 2x, that's when you really want to bet against something. That's why we launched recently minus 2x real estate. We think the Canadian real estate market is way overvalued. And to the extent that we're giving you the opportunity to short REITs as a way of getting access to the real estate market and shorting it, these are great short-term vehicles. Single inverse we use for hedging. Double inverse used for short-term bets against an underlying asset class, whatever it be, oil, nat gas, gold, REITs. It's just fun trading vehicles. But again, to Dwayne's point earlier, these are a very, very small satellite portion of your portfolio. These are not your core building blocks, okay? Do not use leverage ETFs as a core building block.
There you go. Now, listen, we equate them to rated R movies. You really, you don't want to bring a 10-year-old into a rated R movie. That said, there's an audience for that, right? And I say the 2x there's some fuzzy math there with daily resetting. So we always tell people just use them short term, and you'll probably be fine and tactically. But Steve, I want to see a 2x ESG. I want to save the world twice as fast. Can you help me do that? Okay. Okay. What's another question?
Quick question from Fred. Are managers going to be more transparent with their active management, i.e. turnover, purchases of stock in an ETF, et cetera?
We have
Yeah.
active ETFs, and we have it on delay holding because honestly, our active managers don't want to give away that alpha to the public. Like, we display our holdings on the website, and if you could see that the same day with what's going in there, that takes away our edge. That gives away what we're doing, what we're thinking. So that's why we do like you to know what's in there and have an update in a relatively timely fashion. But it doesn't have to be daily disclosure like we would, for example, for an index ETF.
I think, Eric, I think you coined the term ANTS, right? Active non-transparent is the.
I did. Nobody in the industry likes it, but I think
dig it.
I think it
It's
works.
great.
Thank you.
Yeah, there's ANTS in Canada for sure. There are fully transparent active ETFs in Canada as well. And to Nassim's point, you could be like, well, if I'm a great portfolio manager with a wonderful investment process, I don't want to be front run by my competitors, right? It's kind of like the Russell Recon and things like this, things that go on in ETF land. That said, I think a lot of the fully transparent ETFs that you see in Canada are for asset classes that lend themselves to that, right? So, fixed income, for example, well, you're not going to front run bond trades or something like that. Global equities, our active stuff is North American centric, but it would be equities with call and put writing over top of that. That's where the active management really comes to fore, in addition to security selection. So it's a matter of degrees, but you do find both up here, which is great. Choice is good.
And Dwayne, you're the one you mentioned, the innovation one. Is that transparent or delayed?
No, it's delayed. So very much as Nassim described, it's the delayed holdings, and ours is actually, our ETF invests in the actual fund, so it buys units of the fund. So you're actually getting the true product. So that's where I leveraged or made the comment that maybe a new ETF in the Canadian market, but it's based on and investing in a decades-old strategy with a proven track record.
So I would agree. If I spent all my time researching those stocks, I would consider that my IP. And I get not sharing it. I would have to point out, though, that I think ARK challenges this a little because they've had such success with being ultra transparent. And what it's actually kind of done is also helped an ecosystem form around them. They put their trades out every day. People like to follow along. That would be my only counter. But I would say at the end of the day, ARK's success isn't transparent, it's performance. And so I don't really think the transparency is all that big of a deal. Even in the US, where you might argue it's bigger, it's really I don't even think people know what's in all their ETFs, even the ones that, show you the holdings. I don't know if they even know anyway. So I think it's really more the performance and the strategy.
He had been around for 2.5 years with those ETFs prior to the tech, craze. And, she had raised barely, $100 million kind of thing. And it wasn't until the right market conditions where things took off, and it had nothing to do with transparency.
That's right. It didn't. My only counter is I do find there is a fan base that can form if they can follow along and, you crowdsource your ideas. There's something to there. I'll leave that there. But I don't know. I think there's a marketing angle to it. But again,
she's a great talking head. She can talk every day.
Performance has to come first.
Right.
Yeah.
So,
Just how many people are shadowing her product that could have been her AUM, right? Think about it that way.
I mean, there's a cottage industry to following Kathy Wood's trades, but now there's a cottage industry to tracking Nancy Pelosi's trades. So, I mean, take your pick, right?
Oh, by the way, another killer idea on the house, NANC, Nance, and it's just her portfolio. I pulled this on Twitter and I basically 80% of the people said they buy that. Anyway, just throwing that out there, free on the house idea. Okay, what's another question, moderator?
Quick question. Are mutual funds morphing into actively managed ETFs?
Oh, I guess that's probably by morphing. I think you mean converting. Has anybody done a conversion up here?
We have our active business. We have our ETF business. There's certain products that we have on the ETF shelf that run similar strategies. Like there might be one that can be better replicated in a market maker basket, so it can be presented as an ETF. So there's different ways you can take an active mutual fund and have a theme or take advantage of your management talent. But unlike some of the shops in the US that have just straight up taken their mutual fund business and turned it overnight into like a top 10 ETF issuer in the US.
EFA.
That's yeah. I wasn't trying to drop another
I'll
name,
say
but
it.
you know.
But I mean, has there been any conversions like that in Canada? I actually don't know.
It's closed-end funds converting to ETFs per se, but no
Not a
real
mutual fund.
mutual funds converting. All the mutual fund issuers issuing
Yeah,
ETFs,
that's
and
different.
I think at some point, both Trevor and Dwayne are going to have to close their mutual fund businesses, and they won't sell them anymore. That's what I'm hoping. Anyway, everybody's going ETFs. Okay, that's where this world is.
I will say, if I was in a mutual fund company, there is a benefit to converting in that you do get to come over with your assets and track record, because it's a tough industry, and to come over with a little bit of weaponry in that brutal environment, I could see the appeal. And I don't think over here, investors seem to not care like the ones that were in those funds, but it's a decision that each company has to make, I guess. But certainly the clonish ETFs that come out that are very much like the strategies, that's happened everywhere.
And I gotta give you full marks there, Stephen. It took you an hour to get in that little jab there on mutual funds. Usually you're a little quicker off the mark.
Well, I don't have the large asset management base behind me like the three of you guys do to help seed all of my new passive index strategies like you guys all do. So,
And Eric,
I
up
go
here in Canada, we have
I
some.
sell. So
Up here in Canada, we have some advisors who are only licensed to sell mutual funds as well. So as they start to evolve their education and become more able to use ETFs, you could see that trend start to continue. But right now, we've seen explosive ETF growth here in Canada and mutual fund growth. It hasn't come at the expense. They are both going up together.
Well, I mean, is that true? Like mutual funds have seen inflows over the past 12 months?
So let me pull up my
Up here
Bloomberg
is
here.
very true. Up here, mutual funds this year are outselling ETFs about 2 to 1.
That's
The
wild.
exact mirror has been true in the last 5 years. The opposite.
Can I ask you a question on that though? Is that because there's less fee-based advisors and more commission-based advisors? Because here a lot of it shifted to the fee-based model. Is that, or is it just investors there are just fine with the mutual fund? It's a bit more complex here. Bond active mutual funds have done fine. The active equity mutual fund though is in a lot of trouble. I mean, there's a lot of outflows. But on the flip, there's a ton of inflows into equity ETFs. Fixed income a little more nuanced, but part of that is because advisors, the way they get their payment structure. I won't get into the weeds there, but is that happening up there where advisors don't get a commission from the mutual fund anymore? They get paid as a percentage of assets?
there's a huge shift from commission to fee-based, and I think our world used to be 20-80 3 years ago, and now it's 80-20 from a fee-based versus.
Oh, okay, gotcha.
Based.
That's
So
interesting. Yeah,
it's very similar to the US in that regard. But mutual funds this year, I mean, I think we can very easily see most of the sales are really coming in the balanced mutual fund part of the
retirement
ecosystem itself. So it's really the one-stop shop, buy it and forget it type of investments that we're seeing, which is how better fall into the asset allocation ETFs here in Canada that Nassim was talking about earlier.
Yeah, definitely. I'll turn to the moderator. Any last questions?
Gentlemen, you guys have nailed it. Like, you've been in the cherry on top of a great conference for the last 2 days. You've nailed a lot of them. I mean, there's some little granular ones, but you've hit them, the general themes. So I just want to thank you all, Eric, Nassim, Trevor, Dwayne, and Steve, of course. Again, we at Money Show appreciate you beyond words. Your insights are phenomenal. And again, this has been a cherry on top of a great 2-day event. So we thank you for the participation, and we want to thank everybody who attended over the last couple of days. We're doing another Canadian Expo, I should say, November 30th to December 2nd. And we look forward to seeing you there. Any questions, comments, concerns you have for us at Money Show, send them in, because it makes us better and we continue to refine the process. But gentlemen, again, thank you to you all. We wish you a great evening and a great rest of your week. And we appreciate the insights. So thanks again.
Go ETFs.
Go
Thank you.
ETFs.
Thank you very much.
Great day, guys. Thank
All
you.
right. See ya.
See you
Great
guys.
job. Bye-bye.